The trading card hobby has exploded in popularity over the past several years, drawing in collectors, speculators, and casual fans alike. High-profile sales of rare items, such as the 1952 Topps Mickey Mantle card that sold for $12.6 million in 2022, or the ultra-rare Pokémon Illustrator Pikachu card purchased by Logan Paul for over $5 million. They have both captured mainstream headlines. Even today, the purchase of a Kobe Bryant and Michael Jordan dual signed Logo Man 101 for a record $12.9 million has dominated headlines recently. These figures, at first glance, create the illusion that sports cards and Pokemon cards are a lucrative form of investment. However, the truth is far less glamorous. Trading cards are highly illiquid, subject to hype-driven market cycles, and the lack of fundamental qualities that make traditional investments sustainable. One of the most misunderstood aspects of card investing is illiquidity. A card might be appraised or valued at a high price in a price guide or marketplace listing, but that number only matters if someone's actually willing to pay it. Unlike stocks, which can be sold instantly on exchange, trading cards require finding an individual buyer. This process can take weeks, months, or may never happen at the listed valuation. For example, while auction houses like Golden Auctions or Heritage Auctions have occasionally brokered million-dollar sales, the vast majority of sellers do not have access to those networks or the high net worth buyers within them. A collector might own a graded Michael Jordan rookie card valued at $200,000 according to past sales, but in practice, offloading it could require significant time, seller's fees, and negotiations that ultimately reduce net profit. For mid-tier and lower value cards, the illiquidity problem is even worse. Sellers often discover their assets are worth far less than expected when actually brought to market. Card markets are also notoriously trend-driven. Unlike traditional investments, which are tied to underlying earnings, dividends, or cash flow, trading cards derive their value almost entirely from cultural momentum and consumer sentiment. This creates dramatic boom and bust cycles. During the COVID-19 pandemic, for instance, trading cards surged in popularity as people sought nostalgic hobbies and alternative investment outlets. According to eBay's 2021 trading card report, sales of Pokémon cards increased by 574% from the previous year, and sports card sales also more than doubled. But by late 2022 and 2023, prices for many of the same cards had dropped by 30 to 70% as hype cooled. A Charizard base set card that sold for $300,000 at peak demand later fetched under $150,000 in subsequent auctions. These cycles mirror broader collectible markets. Sneakers, for example, experienced a resale boom in the late 2010s, but saw resale prices collapse by 2023 as supply exceeded demand and cultural hype shifted. Similarly, comic books saw massive appreciation in the 1990s before a market crash that left many collectors with assets worth a fraction of their purchase price. Trading cards follow the same volatile pattern, showing that hype, rather than stability, drives pricing. It is true that some rare, high-grade cards maintain or even appreciate in value over the long term. The problem is that these cards represent only a tiny fraction of the overall market. The average collector will never own a $1 million mantle or a one-of-a-kind Pikachu card. Instead, most will hold their mid-tier items that depreciate quickly once demand wanes. The misleading focus on outlier sales is akin to pointing at lottery winners as proof of a sound financial strategy. For every iconic card that sets a record at auction, tens of thousands of collectors are left holding assets that are stagnant or declining in value. This imbalance makes trading cards a highly risky and impractical form of investment for most participants. One of the most fundamental reasons trading cards are poor investments is their lack of intrinsic value. Unlike traditional asset classes such as stocks, bonds, or real estate, trading cards generate no cash flow, dividends, or rental income. A share of a stock represents partial ownership in a business that creates products, earns revenue, and distributes profits to shareholders. Real estate not only appreciates in value over time, but can also produce steady rental income. Even commodities such as gold and silver, while not income producing, have industrial or practical uses that establish a baseline level of demand. Trading cards, by contrast, have no function beyond their collectible appeal. Their worth is entirely perception-based, the value exists only as long as others are willing to pay for it. This dependency on sentiment creates an inherently unstable pricing model. When demand surges due to hype, such as during the COVID-19 collectibles boom, values can skyrocket. But when cultural interest wanes, these same values can collapse just as quickly. A card that sells for $50,000 in one auction may struggle to attract half that amount a year later if interest has shifted elsewhere. The absence of intrinsic value also leaves the market vulnerable to manipulation. Influencers, auction houses, and even wealthy collectors can create artificial hype around certain cards by strategically publicizing big sales or showcasing their holdings. For example, when Logan Paul purchased the Illustrator Pikachu card for over $5 million, it fueled the perception that Pokémon cards were a booming asset class. But this was a single, highly publicized transaction that does not reflect the broader market, where most Pokémon cards sell for under $50. A market that relies on headlines rather than fundamentals is inherently fragile. Another consequence of lacking intrinsic value is that trading cards have no floor price to fall back on. A publicly traded company may see its share price fluctuate, but the business still produces revenue and assets that prevent the stock from going to zero. Real estate markets may cool, but properties maintain some level of utility as homes, offices, or land. With trading cards, however, if cultural interest fades entirely, the cards could become nearly worthless. This already happened with Beanie Babies in the late 1990s, and with large portions of the comic book market after its 1990s bubble. Cards are not immune from the same fate. Sports cards and Pokemon cards share the same flaws that plague other collectibles such as sneakers, Beanie Babies, and comic books, speculative bubbles that eventually burst. Each of these markets has gone through phases of explosive growth followed by steep declines. The sneaker market, once touted as a new asset class, saw the resale value of many shoes collapse by over 50% in 2023 as buyers moved on to other trends. Beanie Babies, once selling for hundreds of dollars a piece in the 1990s, are now practically worthless outside of a few ultra-rare examples. Cards are not immune to this fate. Their current boom mirrors past collectible bubbles more than it reflects sustainable long-term growth. For those seeking true investments, traditional asset classes provide stronger opportunities. Stocks, bonds, index funds, and real estate all offer liquidity, stability, and in many cases, passive income. For instance, an S&P 500 index fund has historically returned about 10% annually over the long term. Real estate can provide steady rental cash flow while appreciating in value. Even more speculative assets like cryptocurrencies or startups offer greater liquidity and broader buyer bases than trading cards. Additionally, investors benefit from regulated markets, standardized pricing, and greater transparency, qualities that the collectibles market lacks. While collectibles can be enjoyable as hobbies, they should be seen as discretionary purchases, not serious financial investments. Sports cards and Pokemon cards may hold cultural and nostalgic significance, but as investments, they fall short. Illiquidity, hype-driven cycles, lack of intrinsic value, and reliance on rare exceptions make them unreliable and risky for long-term wealth building. Comparisons to other collectible bubbles reinforce this reality. Investors looking to grow and protect wealth are far better served by focusing on traditional assets like equities, real estate, and bonds, markets with stability, transparency, and proven long-term returns. Collecting cards can be fun, but mistaking them for an investment strategy is a gamble few will win.